Hello and welcome to a new episode of Under 360 English channel. Today, this is the third episode of the currency trading tutorial, and today we are going to discuss about how the currency prices are being varied, or what are the factors basically decides the fluctuation in currency trades. So keep watching. The first factor that drives the change in currency price is nothing but the rate of inflation. A consistent increase in the general prices of goods or services over a period of time is usually called as the inflation. I believe you know that. As a consequence of an increase in the price of goods or in the services, the purchasing power of the country's currency falls. In simple terms, you can say this means that you can purchase fewer goods with the same amount of money when inflation rises. For example, say you can normally purchase 1 kilogram of tomatoes if that costs 30 rupee per kilogram. With an inflation increases, if the tomatoes price increases to 60 rupee, in that case you can purchase only half a kilogram with the same price. This is what inflation is. So the rate of inflation of a country has a huge impact on its currency. A high rate of inflation causes the value of currency to drop and depreciate, wherever a low rate of inflation causes the value to appreciate. I hope you got the point. The second factor is the balance of payments. So balance of payment is essentially basically it's a statement that shows the difference between the inflow of money into a country and outflow of the money from that country. So that particular statement, balance statement, usually it's generally compiled for a specific period of time, to say that's a quarter or a half yearly or an annual one. So it taken into consideration of a country's imports and exports of goods and service, because usually the inflow of money is through exports and outflow is through imports. So a deficit in the balance of payment means that the outflow of money is higher than the inflow. This means a country is paying more than it receives. Naturally, in this case, the value of country's currency will depreciate. That's the main reason why all governments, even our government also, trying to minimize the imports as much as possible. The third factor is the government debt. This is also known as the public debt or national debt. It is a measure of how much a country's government owes its creditors. So, a country's government, in a bid to finance the yearly budgetary spending, generally borrows money by issuing bonds or treasury bills and other securities. So a country with high government debt is more likely to experience a decrease in value of its currency when compared to a country with low government debt. The fourth factor is the terms of trade. The terms of trade is basically a ratio that indicates a country's average export prices with respect to its average import prices. So mathematically we can say it's like the terms of trade is equal to the index of export prices divided by index of import prices, that's into percentage. So if the export price of a country are more than the import prices, the value of its currency would increase, because the country is getting more foreign currency. If the imports are higher, the value of currency obviously falls. The fifth factor is the status of the economy, most important point. So the country's economy plays a major role in determining the exchange rate of its currency. When an economy is in the recession or in a slowing down mode or in a depression, the country's central bank tends to reduce the rate at which it lends money to other banks and financial institutions in a bid to boost the economy. A drop in central bank's lending rate, that means in our case that's a RBI. RBI's lending rate would increase the circulation of money in the economy, which would then increase the rate of inflation. As more money flows through the economy, inflation increases. Already we told that a high rate of inflation depreciates the value of a currency. Sixth point is the political scenario. A country's political stability also has the ability to influence the exchange rates of its currency. So there is nothing that traders or investors, generally, they don't like the uncertainty in governance. That's the main reason why majority of these African countries or unstable political scenario like countries or neighboring countries like Pakistan or some African countries, hardly very few investors, they will invest money with confidence. So a stable economy, a stable political scenario is much needed to stabilize that economy. So a country with an unstable political scenario generally is less attractive to investors. They won't invest at all. So this can end up decreasing the value of currency. Also, other political events and decisions also tend to affect the currency rates of the country. And an excellent example is last year's or a couple of years back, the Brexit referendum. How Britain is going to exit from the European Union. So, which caused the pound to decline steeply and then brought a lot of slumps and an overall decline compared with the pre-referendum rates. So what the people as well as the business community was expected is when Britain exit out of the European Union, that won't be good for the economy nor for the business. The last and seventh factor, main factor, is nothing but the market sentiment. The public perception of a country's currency also has a very good effect, very good or bad effect on the currency exchange rates. So generally the currency market sentiment is powered by news reports or the current happenings generally. And if the currency market perceives or they have a feeling that a country's currency is in a positive note, then the demand would see a sharp increase, that everyone try to collect the particular currency as a secured investment. So on the other hand, if there goes something bad about that country and currency, obviously everyone start to sell it off. So that currency rate goes down. So what we have seen is as a currency trader, it is important to keep an eye on all these seven factors since they can significantly influence the way you take up decisions. For example, if you are a currency trader, USD INR, you have to keep a close look on the global events, the Indian economy as well as the US economy. So let's quickly recap the session. First thing what we told is a consistent increase in the general prices of goods or services over a period of time is generally termed as inflation. As a consequence of increase in prices of goods, the purchasing power of the country's currency falls. Second thing is a high rate of inflation causes the value of a currency to drop and depreciate, whereas a low rate of inflation causes the value to appreciate. Third point is the balance of payments. That is essentially a statement that shows the difference between the inflow of money into the country and outflow of money from that same country. The fourth point is a deficit in the balance of payment means that the value of the country's currency will depreciate. Sixth point is a country with high government debt is more likely to experience a decrease in the value of its currency when compared to a country with low government debt. The seventh point is the terms of trade. That is basically a ratio that indicates a country's average export prices with respect to its average import prices. If the export prices of the country are more than its import prices, the value of its currency, that particular country's currency, would increase because it would drive up the demand of that currency as a safer investment. And the last point that we have discussed was any country's economy and political stability that plays a vital role in determining the exchange rate of its currency. So this is the end of the third episode, and in the next episode we shall discuss about the 10 must know things about Indian currency trading. So these are the primers. Never skip any episode. Keep watching. So see you in the next episode. Till then, bye from Manu.